Hey guys, you love that we break things down by the decade, and we're going to be talking about an exciting one today, the 30s, the messy middle.
Yeah, this is the messy middle. You know, sometimes we in our 30s, we just need a little bit of help. We have thousands of things pulling on us, whether it's family or job or community or all these things. Wouldn't it be great if there was a compilation that walked you through the things that you need to be thinking about when you're in this pivotal decade?
So this will keep you on track, keep you motivated, and also load you up with tons of free advice.
It's Brian Preston, the money guy.
All right, so now let's talk about, again, in your 30s, where should you invest and what investments should you avoid? So, Brian, you say this all the time. Now it's time in your 30s. You got to grow up. You gave the 20-year-old counterparts some relief. In your 30s, you better be saving 20 to 25%.
I am a son of a gun on this, guys. And I know trolls, you come at me because I'm ready because at this time, I'm telling you, by the time you're in your 30s, you need to be saving 20 to 25%. You are a freaking grown-up at this point. Act like a grown-up and start saving the money. So do it. Make it happen, and you will, I promise you, your 40, 50-year-old self's going to give you a huge sloppy kiss and a bear hug if you do this thing right.
So, you know, it's in that same vein, you are, in fact, a grown-up. So now you do have to focus on things like risk management. Maybe some of the things that you neglected in your 20s. Once you have people depending on you, like spouses, children, aging parents, whatever it may be, you need to make sure that you have the things in place that you need, like life insurance, like disability insurance, like estate documents, all the things out there that could potentially derail your plan.
You do not want life going in the ditch just because you're not here to protect your family. So pay attention to risk management. Target retirement funds, we talked about this in the 20s. They're still popular, but Bo, something starts to happen when you get to $300,000 to $400,000. What are some things when you might be graduating from target retirement funds?
That's why we have an asterisk right here, because we think that once your assets do get to a critical level, you do graduate past sort of the generic solution of target date retirement funds, because not only can you focus on just when you want to retire, you can start looking at customized asset allocations, how you're investing. You can start looking at asset location, what types of accounts am I building, tax deferred, tax free, after tax. You can start looking at strategies to offset income taxes like loss harvesting and capital gain avoidance. At a certain point, your portfolio, just like you grow up in your 30s, your portfolio grows up in the same way.
That is great. I mean, whew. Man, we're knocking this thing out. Let's hit the investments. Now that we've been all positive and motivational, let's kind of want this thing and put in what investments to avoid.
Now, this first one I thought was really interesting. We have on here paying down low interest. And I'm like, bro, Brian, I thought paying down debt in your 30s, that's a good thing. That's something we should be encouraging and preaching.
I want everybody to be debt-free in their 50s. If you are in your 30s, in your 20s, and in your 30s, you are blowing it if you're paying down that 3.5% mortgage. You need to be, look.
I love it because we used to speak so like PC on this.
Yeah.
But you're taking a stand firm. You're saying, no, look, that's.
If you're under 45 years of age, you should be paying your mortgage and making sure you're getting that 20 to 25% savings for the future. You need to be doing the Roth IRA. You need to be loading up the retirement accounts because I'm telling you, compounding interest is your biggest asset, that time of the money working for you. I want you debt-free, but you're going to be debt-free in your late 40s and your early 50s. There is so much time to get out of debt. You don't need to misappropriate those assets while you're in your 20s and 30s, which is the ripest, richest, chunkiest times to get that compounding growth. So focus on that.
You know, another thing that I do see in my and paying down low interest debt, that's like I'm going to say the good side of it. The bad side of it, and we see this all the time in the 30s, this is when lifestyle creep starts to happen pretty significantly. You buy the bigger house. You get the nicer car. You just have to have the jet skis or the boat. It's where you let your life start to get a little bit out in front of you.
High school doesn't end at 18, guys. You know, you're going to be experiencing the same insecurities you had in high school. It's just much bigger toys and expenses and credit card debt and other things. So avoid the lifestyle creep. You don't have to keep up with the Joneses. They're all broke. I'm telling you, I've seen the stats. You can take yourself out of that game because just assume all people who have more than you are probably in debt. It's a great coping mechanism. So do that, and I think you'll be in a good place. So let's talk about, we picked on our 20-year-olds, but let's pick on our 30-year-olds too. How do they blow the whole investment game?
They do the same thing. They try to outsmart themselves. Being successful as an investor is incredibly simple until you complicate it. And we see this all the time with 30-year-old portfolios. They have the individual stocks. They got into Bitcoin. They're doing the cannabis. They're trying the penny stocks. They're doing option strategies. All that is fine and well, but man, if you're not doing 20 to 25% in the boring, plain, vanilla, easy stuff and playing over here with this other stuff, I think you're missing the mark and you're making a big mistake.
You know the worst thing you can do in options?
Oh, I know, because we've done it.
You can make money on your first option trade.
We did it.
That's good. That sets you up to thinking you're a genius. Don't fall into the trap of thinking, oh, I'm so smart. Overconfidence is a true issue you need to be careful of. Buy into the market, buy into the innovation of the future. You do not have to recreate the wheel. So but experience definitely creates wisdom on that. Take it from some guys who've blown that in fortunately small increments so that the big money can continue to grow.
Play money, big money. I love that phrasing. That's perfect.
Let's do the numbers to build perspective to kind of show them why it's so important that they need to be saving money.
So again, from the Bureau of Labor Statistics, we wanted to go look at the average income in this country for a 30-year-old as well as a 35-year-old. And we found that the average income for a 30-year-old is $45,000 a year. Average income for a 35-year-old is $54,000 a year. Well, if you want to be a millionaire and you wait until either 30 or 35 to start saving, for the 30-year-old, you have to save $270 per month to get to $1 million. For the 35-year-old, you have to save $452 per month. Well, if you look at that in percentage terms, for a 30-year-old, you have to be saving 7.2% to get to $1 million by the time you get to 65. Again, good news, on average, 30-year-olds are saving 8.2. So again, a little goes a long way. And then if you wait till 35, the number goes from 7.2 up to 10%. You have to be saving 10% of that $54,000 income to get to $1 million by age 65.
So here's the things, there's several things to take from this. First of all, for a 30-year-old, we use 9% rate of return because we know that you're not getting what the 20-year-old's getting with the 10%. And then for a 35-year-old, we even brought it down to 8.5% because the older you get, the more risk you have to kind of dial down and you're going to add more diversification to your portfolio. So you can see to be a millionaire, 7.2% of your savings based upon average incomes for a 30-year-old, 10% for 35. But $1 million is not going to be the same for a person who's 30 or 35 years old. So let's take into account the $3 million. Because when we were talking to Sarah, the next millionaire next door, she had kind of mentioned that inflation adjusted, $3 million is kind of now the ding, ding, ding number
mark,
that people are really, if you want to be, we did a FIRE episode recently, $3 million is kind of a big threshold where you're living a really good life. So what do you need to be saving as a 30-year-old? It's 21.6%.
That comes out to $811 per month. That's some pretty serious chat. And then for the 35-year-old, it actually goes up to $1,356 per month.
Or 30.1% of their income of $54,000. So that's why when you hear us talking about you got to be saving 20 to 25%, it's amazing to me, Bo. We've been doing that stat for years. But when we actually put the data to it, you're like, it's amazing. This is exactly how this all lines up. So pay attention to that stuff.
So we talked about, what was required to be a millionaire by 65. If you were a 20-year-old, it was $95. Well, maybe in your 20s you didn't figure it out, but you're 30 right now and you figured it out. So how much do you have to save to be a millionaire by the time that you get to 65? By our calculations, it's about $270 a month. So what does that mean? You will, over the course of your career, have saved $113,400. So you've actually doubled what the 20-year-old had to save, but that's okay because still 89% of your $1 million was from growth, was from compounding interest, was from the market, was from your army of dollar bills working for you.
Wow, just those growth levels, 95% growth for the 20-year-olds, 89% growth for those in their 30s. Guys, that's once in a lifetime opportunity. So you're probably, and I talked about this earlier, how do you determine between traditional contributions versus Roth, which are tax-free growth? But we've tried to break it up, and we have a kind of an indicator of 30%. If you take your federal tax rate, your marginal federal rate, and then your state income tax rate, it's around 30%. But we need to go deeper in that because a lot of people will hear that and be like, give me some numbers, Brian. I need to know numbers. What's the actual details?
So if you are someone who files a tax return and you file as a married filing jointly, you want to pay attention to the 24% tax bracket, and that happens at $171,050 for a married couple, or about $85,000 for a single couple, or for a single couple. That doesn't make any sense. For a single person, if you fall below those thresholds, there's a chance that Roth makes a lot of sense for you. You're in the lower tax bracket. Go ahead and take advantage of that tax-free growth.
And it's also that 89%, that's talking about value of your army of dollar bills, compounding interest. Tax-free is going to be really powerful, but you do need to be mindful as you have more success at work. There will come a threshold when you have enough success that you're in those higher tax brackets. Right. Maybe the tax-deferred growth or traditional way of saving is even better.
Yeah, what we figured is like if you look at the 32% bracket, it's like $326,000 for a couple, or it's $160,000 around there for a single person. If you're above that, pre-tax makes sense. Well, you may have noticed there's a big gap, right? Yeah. For couples, it's a gap from 170 to 320, and for single, it's from 85 to 160. It gets a little varied. It gets a little nuanced, and it depends on your unique state that you live in, your unique tax circumstances, your unique age, your unique goals, your unique account structure. Maybe a blended solution makes sense for you inside of that range, but outside of that range, it's kind of a no-brainer.
Well, hearing those thresholds, I think there's going to be a lot of people that ought to be, if you're in your 30s, you're probably going to need to be looking at the Roth option, because there's a lot of opportunity there, a lot of meat on that bone, as we like to say.
Yep.
So let's talk about, I want to talk about how much should you be saving, how much should you have. Let's talk about the Money Guy way and the research we found.
So again, remember, what we laid out is if you wanted to start saving and you didn't begin until you hit 30, and your goal was to replace 60% of your pre-retirement income, right? And we're going to assume that your income just increases by 1.5% every year. How much would you need to save to have a pot of money that will last you from 65 all the way through 95? Well, if you're someone who's 30 years old, you got to be saving 15% to do that. To replace 60%, you need to be saving 15. If you wait till 35 years old, that number jumps to 19%. And if you're someone who waits till 39, you're on the cusp of the top of the hill, you got to save almost a fourth of your income, 24%, in order to replace 60% of your pre-tax income in retirement.
And we talk about Money Guy. If I was talking about Money Guy way, we always talk about 20 to 25%. I want you to be that hyper saver status. You can see 30-year-old, because compounding interest is so powerful to you, you can actually save a little less than that. But I want you to think about abundance. What can you save to actually get you even more? If you do save 20%, and you're 30 years old, you can see now you're going to have a retirement that's not 60% of your income. It's going to be 81%. Remember, in retirement, you don't have to save for retirement. You don't have to pay as much in income taxes. So that 81% that you're going to get at age 30 is going to feel like a great retirement.
Absolutely.
Same thing at 35. I think this is amazing. This shows how the math works. 19% savings rate is what's projected there. Gets you 62%. That's right in line with the 20%, matching up perfectly. Same thing, 39-year-old, you're saving 24% of your income. You'll get about 49%, a little less, but this is common sense. If you waited, meaning because every one of these scenarios assumes you started at zero. That's a 39-year-old who has zero retirement savings. It's not game over for you.
That's right.
If you start doing hyper saving status of 20 to 25%, specifically 24% in this illustration, you still have a retirement that covers half of your income. You stack Social Security on top of that, you're in a pretty good place.
That's exactly right. I'm going to say it again just for the people in the back. If you can save somewhere between 20 to 24% as a 39-year-old, you can expect to replace somewhere between 49 to 60% of your pre-retirement income. It's pretty amazing, pretty powerful.
By the way, if you want to get depressed, hang around for the 40s and 50s, assuming people didn't start, because this is what situation you'll be in if you don't use this as motivation. Because this is the sad part, and we put fidelity balances in here for 30-year-olds. You can see the average balance is $18,500. You can see the median is $46,200. Bo, that doesn't strike me as those are people that will be living in abundance at retirement.
Those are not the Money Guy mental financial mutants. So we don't want you to shoot for, if the average is 18, I guess that's where I need to be. If the average is 46, I guess that's where I need to be. We want to give you a better number. If you are a Money Guy mutant and you've been doing what you're supposed to be doing through your 20s and through your 30s, we think that by the time you're leaving your 30s, you should have 2.6 times your annual income saved by the time you get to 40.
Yeah, from overachievers, you're trying to get between 2.6 to 3 times your salary by the time you reach 40 years of age.
Yep.
We know 20-year-olds know that their money is worth 88 times over, meaning every dollar they save or spend has the potential by the time they're 65 to be the equivalent of $88. We also know from the previous slide and the drop in rate of returns that you expect as you get older, you take risks down. It's $44 for a 25-year-old who spends $1. What happens to people in their 30s?
Yeah, so once you get to 30, your wealth multiplier is actually 23. So now that's still super, super exciting. What that means is every dollar you save at age 30 can turn into $23 by the time that you turn 65. So there's still a lot of juice. But look at what happens as you move through your 30s. And again, if you want to go see this, go out to our website, moneyguide.com, go to our resource page. This is actually a resource available for you guys out there. You can download it, share it with friends. We want you to have it. But look at what happens as the wealth multiplier moves through time. It starts at 23 when you're 30. Well, by the time you get to 35, it drops to 12. And by the time it gets to 39, now you're in single digits. It's down to 8. And so when you hear that, you might be thinking, oh, well, that's sad. That stinks. That's not. You should be thinking more about, okay, have I done the hard work in my 20s? Because this is where it gets really excited. If you're a 30-year-old who really busted in your 20s, and maybe you've saved up $100,000 by the time you get to 30, which is incredible, that $100,000 without you saving one more dollar has the ability to turn to $2.3 million.
It really is the last stop on easy compounding growth. So, because you'll notice once you get into your 40s, you don't see double digits anymore on this. So that's why pay attention. We want compounding interest to work for you. So it's important to get to work. Now, we said this in pre-show, and I think it's worth, because this is why we say it's the last stop. Still, even a 35-year-old, that's less than what you have to fund on a Roth IRA to be a millionaire, meaning $500 a month. So it's at $452. It's still possible. I don't want you guys to get overwhelmed thinking we're poo-pooing the opportunity to become seven-figure wealthy. But it is one of those things you just need to be deliberate. Let your money work for you because it's the last stop.
At 36 years old, all you have to do is max out your Roth IRA and you're on your way to being a millionaire by the time you're 65. Now, I think that's pretty powerful.
It is powerful, especially because the next point is that you are now 10,000 hours. You're getting traction in your career at this point, and that's why we think the strategy's there is because you do have the hours put in. You're no longer learning your trade. It's no longer a job. Hopefully now you're working in a career. Make that happen. Make that be something that is an asset towards your financial success.
Yeah, I think a really big indication that you are in this strategy phase is that it's not just a job. You said it perfectly. There's actually more to what you're doing on a daily basis, and you're actually using that to move you forward. And then I think the other thing that psychologically happens in our 30s is that now you begin to say no, not out of necessity, but out of discipline.
Yeah.
In your 20s, you have to say no to a lot of stuff because you just can't afford it. You don't have the money.
That's exactly right.
In your 30s, maybe you do have the money. You say, no, I'm not going to buy the luxury car because I have other goals. I'm not going to increase the house because I have other goals. You make those decisions out of discipline instead of out of necessity.
And it also keeps you, don't keep up with the Joneses. Don't look at Joe Blow down the street because Joe Blow is probably broke, crying at night, putting himself to sleep. Save the sexy cars for when you're a little bit older. You need those dollars working for you. That army of dollar bills is so powerful. Don't mess it up. And this is also the part, you said it best, when we did about the 20s. How consistent are you, Bo? Because there's going to be a chance for you. A lot of people, you said it, a lot of your friends started saving like a Roth IRA or started funding it partially in their 20s. But then you look at them when they're 33 years old and they still have the same funding levels. Don't do that. This is your chance to actually be consistent with your savings goals, but also be consistent with your consumption. Don't let somebody, just because you can, doesn't mean you should.
Love that.
What part of the net worth statement should we focus on in our 30s? The first thing, and this was kind of interesting when we came up with this in show notes, because everybody, when you think net worth, you think, okay, assets minus liabilities equals my net worth. We didn't start there, Bo.
We did not start there.
We actually started with what? Footnotes. Notes that you should put at the bottom of your net worth statement. What do we mean by that?
The reason we think the footnotes are so important is because of exactly what you just said. Maybe in your 30s you're getting married. Maybe in your 30s you're starting to have kids. What we're saying is really now your life isn't just based on you. There are other people that are now depending on you. So you want to make sure that you have all of the appropriate risk mitigation measures in place. You want to make sure that you do have your life insurance in place. You do want to have your wills in place. You don't have those things. Well, they don't normally find themselves
on the net worth statement. They're not an asset. They're not a liability. So they tend to be a footnote at the bottom or on the second page.
I think it's interesting. I just saw this on Twitter in the last hour or two, is that there were more cash value life insurance policies than there were than term.
Really?
And so this is something I want to tell my 30-year-olds. There's a good chance that you need those assets. You need the income to be allocated out efficiently because you've got kiddos, you've got a spouse, you're trying to buy the house, plus you're trying to build the savings habit of having army of dollar bills building for the future.
Yep.
You're just trying to prevent, if you got taken out on a Tuesday afternoon, that you don't leave behind a big mess for your family. Term life insurance is actually probably one of the most effective ways to do that. So I make that statement just to understand that you might want to go look at just some simplistic benchmark rules that you see out there in the industry. 10 times your income.
Absolutely.
I mean, if you go look at 10 times your income, go look at 20-year, 30-year term, I think you'll find it's much more affordable because you're basically buying just the cost of the insurance. You're not trying to overpay now so that when you get to be 70 years old, that all those overpayments cover the increased cost of the insurance. We're not worried about that just now. We're just trying to cover the insurable need that you have.
And so obviously life insurance covers the big thing. It covers the financial responsibility. But if something were to happen to both you and your spouse, you want to make sure that you have stuff in place that'll say, what happens to the kids? What happens to the assets? What are my ultimate wishes? That's why estate documents are so important. And unfortunately, it's a weird conversation to have. Okay, if something happens to us, who's going to watch the kids? If you think it's difficult for you to have that conversation while you're here and can speak for yourself, imagine how difficult it's going to be for the rest of your family to try to figure it out. That's why we hate seeing people in their 30s neglect this, because it is so, so important. Hopefully you do them, you get them filled out. You never need to use them, but they're in place just in case.
Let's transition to beyond the footnotes. Let's talk about liabilities. We started this, even though it's not the top of your net worth statement, liabilities are still one of a big concern I think you have in your 30s, because this is the time you're buying a house.
Sure.
So you want to make sure, because your biggest expenses are like automobiles, houses, but these are also huge financial traps where if you have all of your monthly budget going to those two big purchases, what's left for you to actually save and build your army of dollars? That's why we give you the guidance. Your mortgage plus your housing expenses should really not exceed 25% of your gross income.
That's exactly right.
Now, a lot of people on the coastal communities, you're like 25%, that's laughable. We probably need to spend 35%. I get it. I'm going to give you a little bit of grace on this, but understand if you take 10% here, of that grace, you better be cutting somewhere else so that we can continue to build the savings habit.
Now, notice what we said there. We didn't say, oh, if you have a mortgage in your liability column, your goal should be to pay that mortgage off as quickly as possible. In your 30s, in our opinion, that should not be your goal. Your goal should be to make sure that your mortgage is an appropriate amount and it falls in less than 25% of your gross income.
Other big purchase, cars.
Yep.
We talked about this for 20s, but I'll quickly repeat it again. 23.8, 20% down payment. Don't finance for more than 3 years or 36 months on the amortization. Cannot be more than 8% of your gross income. And here's the other two caveats. You do not want your monthly investments to be less than your monthly car payment. If you got those two backwards, meaning you have like $1,000 a month car payment and only $200 a month going into your Roth IRA, you're doing it all wrong. Make sure that the investments are bigger than the car payment. Also, if you get those luxury brands, you better be treating it same as cash. Essentially, have it paid off within 12 months.
So then we want to move on to the asset side, to the exciting side. Now, in your 20s, we talked about you want to be looking for an emergency fund. You want to be moving towards that. In your 30s, it's a non-negotiable. You have to make sure that you have your liquid cash covered. 3 to 6 months of living expenses in cash. Usually it hangs out right there at the top of your net worth statement. You got to make sure you check that box before you begin building the rest of the asset column.
When we get to investments, it's interesting. In the 20s, I gave a lot of latitude, and I said, look, I want you to be able to work towards saving 20%, maybe 25%, but it's also aspirational in your 20s. In your 30s, guys, this is the time it's got to happen. You've got to make sure you're getting 20 to 25% of your gross income working for you through your army of dollar bills. It can come from your employer retirement plan and come from your Roth IRA. Just make sure you have investments that are building your army of dollar bills.
The other thing that I think is so beautiful, and it's a magical thing that I think happens for a lot of folks in their 30s, is Your net worth statement, if you're doing it right, should look a lot different at 31 than it does at 39. It's almost a tale of two net worth statements. And one of the things that you'll recognize as you're doing your annual net worth statement, you'll start to see the critical mass of your assets grow year over year over year. Well, one of the things your net worth statement might inform you of is, okay, am I at the level now where it makes sense for me to graduate past an automated investing, automated financial planning solution?
Yeah, because we love, 20s, 30s. I love people. And this is why it's a great time to be alive and a great time to be a builder of wealth. We have what's called index target retirement funds. All you have to come up with is, how much can I save? When do I need the money? When do I think I'm retiring? What's my financial independence period? If you can come up with those two periods, just go buy an index target retirement fund from somebody like Vanguard, Fidelity Investments. These are incredible opportunities. Those are the leading providers of it. However, you're going to reach a level probably around 400,000, maybe 500,000, somewhere in there, where you're going to say, you know what? I need a little more attention to the asset allocation.
Sure.
I also need to focus on tax diversification, or what's called tax location, meaning I want my fixed income in those tax deferred accounts because I go get taxed at ordinary income. I want my Roth IRA to have the best growth assets whatsoever. And then I want my taxable account not only to have liquidity, but I also want to make sure they have the dividends. They have the long-term capital gains, all the things that have some tax favorability. Focus on that. And then don't forget, tax loss harvesting, as well as capital gain planning, meaning that you could even get into charitable planning, charitable giving. There's all kind of cool things that you could help navigate those large financial decisions with.
Yeah, and if you are making large financial decisions, it's perfectly fine if you're using resources like the Money Guy or other resources out there. But if you do find that the gravity of the decisions you're making is maybe more than you want to bear on your own, it's not a bad time to start thinking about reaching out to a financial advisor, start thinking about working with someone who can help you on that journey.
And now this is probably a great point. You're trying to figure out, where do I fit in? What's my spot check? Where should I be? I know, according to Fidelity, they think 30-year-olds should have like 1 times your gross salary saved.
So whatever you make in a year, they should have 1 times annual gross salary if you're 30. Well, we said, let's take it even a step further. Let's talk about someone sort of in their mid-30s, around age 35. And this is what we found. The average median income for someone in their 30s is a touch under $48,000 a year. The average median net worth is right at $45,000. So
Fidelity
it aligns pretty closely. Well, if you want to be an average accumulator of wealth, you want to take your age times your income divided by 10 plus however many years you have until 40. So if you're a 35-year-old, you would divide by 15. You can see that an average accumulator of wealth should have a net worth. This includes all of your investments, all your home equity, all your assets, of a little over $111,000 a year.
But that's not financial mutants.
That's not financial
average accumulators of wealth. When we get into the financial mutants column, you can quickly see that income jumps up to $76,000 a year. The net worth for the top 25%, mid-30s, about $172,000, $173,000.
I think what's so remarkable there is if you just look at the average, it's about 1 times annual salary. You can see the folks who tend to be higher income, at least if you want to fall in the top 25% category, they're doing a great job of turning that higher income into wealth. They're not just at 1 time salary, they're at greater than 2 times salary, which is pretty remarkable.
Yeah, and think about it, because this is also 35-year-olds. That's why, we celebrate those median Americans, but they're really kind of behind, because this is a 35-year-old is what we base these numbers off of. The prodigious accumulator. Remember, we've talked about that modified millionaire next door formula where you take your age times your income divided by 10 plus how many years are you from 40? Well, in your 30s, it's a lot less. It's less than 10. So you can see still a prodigious accumulator is somebody who has that millionaire next door formula times 2. That number comes in for the financial mutants right around $356,000. Let's move on to the next one, because this is one that I love. The slide that was put in on this is kids' education.
Yeah, we all, once we have kids, they become our top priority, as they should. Well, a lot of times we incorrectly assume that because our kids are now our top priority, they should also become our financial top priority. So immediately, as soon as Junior or Juniette is born, we got to start funding that. Why'd y'all laugh at that? That's a good name. We got to start funding those college accounts. We got to start getting them and start building them up
even when that's not exactly where they're supposed to fall inside the financial order of operations.
You and I have done enough flights, and we've made the analogy on past shows, is that they always tell you when you're on an airplane, please put the oxygen mask on your face first before you help the kiddos out.
Yep.
And it's kind of the same way with your retirement. Your kids can go get scholarships. Your kids can go get student loans. Retirement loans, little iffy if that's going to happen. Here's what the actual new retirement, what is funny, I've been making this joke for years. And I am so happy that this has come full circle, that what I have threatened, talked about, and envisioned has actually come true. As I tell people all the time, look, you can get this right or you can get this wrong, but if you get it wrong, you just need to let Junior know you're moving in the basement at some point in the future. And once you know it, the New York Times has an article that just came out. One of our clients, Money Guy family members, sent this to me. I loved it. Look at the article headline. My retirement plan is you. If your kids go, Mom, Dad, why don't we have more money for college? I want you to show them this and be like, it's because I'm not going to live in your basement. Because look at this headline and look at the picture. I mean, this sweet woman, her sweet son. I'm glad that they like being with each other because he's got her. That's the retirement plan for her right there.
Now, look, don't miss here. So there's nothing wrong if you want to have an in-law suite or you want to have the grandparent suite and they want to come live with you. But when that happens, you want it to be because you chose to, not because you were the backstop. And the single best gift, you always say this, the single best gift that we as parents can give our kids is to not live in their basement in the future. Unless they invite us to.
Yeah, unless you choose to, not because you're the retirement. My retirement plan is you. That is a nightmare right there. Also, this is because you have so many commitments. You like I said, you likely have a significant other. You might be, procreating and growing, having more children and having children.
Okay.
So work-life balance becomes more important. And then, this is also where I think you have to pay attention to lifestyle creep.
That's
and
right.
trying to keep up with the Joneses. That is definitely, these are legitimate issues that are definitely a concern.
Yeah, and I think even when we think about lifestyle creep, that's sort of a perfect segue into thinking about in your 30s, how should you think about cash flow? Well, realistically, this is probably the first time in your life that you begin to have some discretionary cash flow for the first time. It's not just about survival anymore. You're recognizing, oh, I have a little bit extra. Well, one of the things you have to keep in mind is that your 30-year-old self is very different than your 20-year-old self. So just because that 20-year-old that you were got so excited about maxing out the Roth IRA at 20, now that you're in your 30s, you actually have to improve upon that. You can't just rest on your laurels of what you did in your 20s. You actually have to get better. Don't let the discretionary cash flow just allow your lifestyle to creep and your lifestyle to expand.
Well, you've talked about it, is that, we've shown the stat that if you want to be a multimillionaire in your 20s, or if a 20-year-old, all you have to save is a little less than $200 a month.
That's right.
But the problem is you fast forward to when you're in your 30s, you probably need to be saving more than a little under $200 a month because you're making more money. Because remember, the goal is 20 to 25% is going towards the long term. So watch out for that. You don't want to also let lifestyle creep, because this is the part we talked about. We know that the average house purchase occurs when you're 33 years of age.
That's right.
When you're in your 20s, I told you I don't pick on the latte factor because I typically want people to focus on the big decisions like the car purchases, the houses, and those type of things that are whittling away. Well, the little stuff's not eating you up anymore.
Right.
And now it really is keeping up with the Joneses instead of little oopsies. Man, I got a coffee today. That's hurting things. Now you're like, oh my goodness, how did I get strapped with this $800 a month car payment? Did I go buy a house that's way too much for where I'm living that I can't save for the future? This is the stuff that will get you in trouble.
Yeah, I remember in my 20s, ouches were like hundreds of dollars. In my 30s, it seems like ouches are thousands of dollars. Another thing that you'll probably recognize in your 30s from a cash flow perspective is you're probably beginning to understand, am I just working a job? Am I just showing up and clocking in and clocking out, waiting for my thing? Or am I actually into the career? Am I settled into what I'm going to be doing for the long term?
And I think that's an important thing. I mean, you want to be planning ahead. We always want to have kind of a vision for what the next 5 years looks like, what the next 10 years looks like. So don't just take it for granted. If you are just putting in the time, you wake up and you just feel like you're on Groundhog Day over and over. Great movie by Bill Murray, by the way. But it is, if you're on that treadmill of life and you're not happy because it's not a career, you don't see a career path, pay attention. This might be the time to figure that all out. This is because, look, there's great performing investments out there, but nothing is going to do better for you than how the size of your shovel. If you can make your shovel bigger, meaning the amount of income you can create for yourself, pay attention to that, because that's going to help out with a lot of the other financial things that we discussed.
And I think we even said one of the 7 traits of millionaires is they chose the right occupation. Well, if you're in your 30s, you should start recognizing, did I choose the right occupation or did I not? And if you want to be a millionaire, which is what we're coaching you through, make sure you make that decision well.
Let's talk about risk management.
Sure.
When you're talking about 30-year-olds, this is, I've talked about, you're starting to get the trappings of life, meaning kiddos, spouses. There's a likelihood that these people are starting to count on you for your income.
That's right.
So if you left early, you always talk about a bus hitting you. I like to think that death is going to come much softer and quieter and nicer to me. But it is one of those things I think you need to plan ahead, and that's where term life insurance, disability insurance, those things definitely should be on your radar. And then, Bo, we talked about emergency funds.
Yeah, an emergency fund, in your 20s, perhaps you can get by with just having your deductibles covered, or maybe operating lean. Because maybe you can go ask mom or dad for money, or maybe whatever there is. Once you start having other human beings depending on you, once you start having significant others and children and that sort of thing, an emergency fund is a non-negotiable. It's something that you have to have in place, because it is going to be that thing that protects you from that, HVAC went out. My kid broke their arm. The car has to go into the shop. Your emergency fund is the thing that makes sure your financial life does not come to a screeching halt.
And just because all your friends are swimming naked out there in their lifestyle and really not keeping cash reserves and building up assets doesn't mean you should, because there will be, believe me, every decade there's going to be some type of crisis. There's going to be something that pulls on your wallet unexpectedly. You need to have margin to make sure you navigate that well. And that leads to, because let's talk about this. I had a client, now this has been a while back. Their child, who by the way was in kindergarten at the time, who now is, this is how long I've been doing this, graduated from college, married. So I've been managing money for a long time.
Really
So
old.
this is a kindergarten when this thing, threw rocks at a bus.
Oh, because that's a great idea.
Went through the window of the bus, or the down window, hit a girl. She had to get stitches. It turned into some litigation. Guess what covered it all? Umbrella insurance. So guys, good time to have insurance that sits on top of your auto policy, your homeowner policy. It's pretty cheap. Look into umbrella insurance. You can get $1 million worth of coverage for just a few $100.
Yeah, if you have assets that you've begun building, or if you have current healthy income or future healthy income, umbrella policies are just too cheap not to have. You want to have roughly the equivalent of your net worth, rounded probably to the nearest million. So for someone in the 30s starting out, $1 million of umbrella coverage is a great solution.
Let's talk about investing.
Okay.
Making those army of dollar bills work for you. This, I'm kind of counting on you. Look, in your 20s, you're broke. I get it. I give you some grace. By the time you get in your 30s, I really, really want you saving 20 to 25% of your gross income. That's a non-negotiable at this point.
And remember, in your 20s, your army of dollar bills was so stinking powerful, like 88 times over, 66 times over. In your 30s, you start to lose a little bit of that juice. Now, it's still powerful and it's still going to work for you, but you better be saving that 20 to 25%, because $95 a month in your 30s isn't going to get the job done.
Well, think about this. When you're 20 years of age, $1 turns into $88 by the time you're 65. Has the potential to do that. Just 10 years later, 30, it's now only has the opportunity to turn into $23.
That's a big difference.
That's a huge difference. Still incredible. I mean, look, as a 40, soon to be 47-year-old, I'm looking at 23 as a great multiplier, but you just need to be paying attention to that. Here's another thing. Kiddos. You're going to start having kids. Focus on your retirement savings. That 20-25% is for you and your spouse and their retirement. You only get to look at saving for the kids' college and other things after you take care of your stuff. So you do need to be saving 25% for yourself, and then you can think about the kiddos and their college savings, 529s,
Yep.
and other things after that. I also think here's something to pay attention to. Just be on the lookout for it. A lot of you, some of you might not graduate to this, but if you are a hyper accumulator, as soon as you cross over about $500,000, $500,000 of investments, you probably are reaching the stage of, hey, have I graduated from index target retirement funds? If you're under 500,000, I still think they're great for you. It's a simple thing. Bo talked about it earlier. Just have two decisions. How much can I save? Hopefully it's greater than 25%. And what year do I need the assets? That's all you have to do with an index target retirement fund. Once you get over 500,000, you might want to get a little more sophisticated because you'll care about tax location, you'll care about loss harvesting, you'll care about gifting appreciated assets for charity. There's a lot of powerful things you can do.
There's just some different weight to the decisions you make once you get to that asset level can have. And just anecdotally, we've kind of seen this, Brian, with our clients. It usually is in sort of that mid-30s to late 30s when that starts to happen. But even though the gravity of your decisions is getting bigger and the size of your portfolio is getting bigger, your savings rate, I would argue, in your 30s is still exponentially more important than your rate of return. So rather than focusing on trying to finagle your investments to squeeze every bit of return out of there, you ought to look at your cash flow and figure out how can I save just a little bit extra in your 30s? Because again, the work that you do in your 30s, your 40 and 50-year-old self will thank you for.
No doubt. And that leads to tax planning. Here's something. Do you do Roth contributions into your employer retirement plan? Do you do traditional pre-tax, meaning you get a deduction on it now?
Sure.
These are all decisions that you're trying to make when you're in this stage. Here's what we think about it. Once you combine your federal marginal rate, your state income tax rate, and it's somewhere in that 30 to 35% range, that's area that's kind of gray zone that it might make sense to more take the deduction now than it is to do the Roth where you get the tax-free growth. So that's why I'm saying if you're under 30 and you're young especially, consider the Roth. But as soon as you get in that 30, 35, you've even said, Bo, 25 to 30 might be in the gray zone on some people.
You may want to split it. It depends on your specific age and account structure and that sort of thing. But certainly if you're in lower bracket, we love tax-free. Higher bracket, we love getting the tax benefit. And that's kind of how we think that 30% is that cutoff.
And the reason this is also playing out is that, look, your income while you're working is going up. So your tax rates will be going up. Your goal or hope is that if you do this correct, and we'll talk about the bucket strategy later, is that by the time you reach retirement, you actually have the ability to manipulate what your tax rate is in retirement because you'll have options. And that means that potentially your tax rate will crater down into the lower rates. So that's when you can do some Roth conversions and other things at that point.
The other thing that happens in your 30s is that, again, messy middle, you're pulled in 1,000 different directions with family commitments and work commitments and community commitments. You may just find that when it comes to like doing taxes and that sort of thing, you just don't have the time. I think a lot of folks recognize in their 30s, man, instead of me doing my own taxes, trying to figure it out, trying to piece it all together, this might be the time from a tax standpoint where it makes sense to reach out and get professional help. There's nothing wrong with doing that. Again, you have to figure out where you want to focus your time and effort. And I'm of the opinion a tax professional might make a lot of sense if you got 1,000 things going on.
What's interesting, I did taxes professionally for over 16 years. Sold my tax practice. I mean, it's been I guess we're getting close to a decade now.
Almost a decade.
I still am paying that because that part of the deal when they bought my tax firm was I had to continue to use their professional services so we'd have a smooth transition for my tax clients. I'm still using a paid preparer.
You still don't even do your own taxes.
And I'm not on commitment anymore because it's kind of fun. I mean, I know fun's probably a weird word for people to hear, but from a financial mutant standpoint, I like being the quarterback of the situation. I write up all my notes, all the things I'm considering. I fill out the tax organizer completely, but man, is it cool to see that thing come back already done, and now I just have to review it and then actually going through and scrambling around to figure out which box to put where.
I would argue that reviewing a tax return is way more fun than preparing a tax return.
No doubt. So it's also a better use of my time. I mean, me reviewing my tax return after a professional's done it, much better than me poking around for hours on end to get the tax return done. So let's move on to estate planning. I told you, you're likely at this stage, you get the trappings of life. You have a spouse, significant other, that leads to kiddos. You're going to need wills if you have kids because you want to make sure that the state is not determining who takes over the kids. If you think a conversation's hard while you're living with your spouse, about the family, because we all have family.
Sure.
And I know those are some weird conversations. Think about how hard that conversation is going to be when you're not even here.
That's right.
And then the state's trying to figure out where your kids go. Make sure you have wills. That's a no-brainer.
And then also, as your life circumstances do change, you get married and you have kids, make sure you're keeping the beneficiary designations on your accounts updated. When you get married, it probably makes sense to switch it from your brother or sister to your spouse. When you have kids, probably makes sense to add contingent beneficiaries or start thinking through that. You just want to make sure that as your life changes in your 30s, your financial plan adjusts to reflect those changes.
And let me give you a head start so you lower your legal bill when you get these wills done. Go ahead and talk to your spouse. This is going to be the harder part of the conversation. Who do you want to be the guardians of your kids if you both died at the same time? Who do you want to be the executors in case you're not here? Because it's easy to say you want your spouse, but what happens beyond your spouse? Sure. Trustees, if you're creating any trust in there, you're going to need to name those as well. These are the hard conversations you ought to have, as well as what type of health care you would like, and just in case there was a bad accident or something.
This seems obvious, but I'm going to say it because it makes sense. Don't let this be a surprise to the people that you've selected to fill these roles. Meaning, if you really want your brother and sister-in-law to be the one to take care of your kids if something were to happen to you guys, make sure you have that conversation with them. If you really want your uncle to be the executor of your estate and to carry out make sure you have that conversation so they know to be expecting that if something were to happen.
It's a great Hollywood plot, not a good life plan when you just let the kids, you die tragically and your kiddos go to somebody. Because there's been so many movies where the ditzy single relative, inherits the kids and then, has this transformation over life. Great movie, horrible life. So don't do that. That's not what you want to do.